Welcome. This is Power Trading Radio Live, fueled by Online Trading Academy. For more information, visit powertradingradio.com. Now, here's your host, Merlin Rothfeld.
Hello, everybody. Welcome to Power Trading Radio. It is your weekend edition. My name is Merlin Rothfeld. Hope you had a great trading session out there. Of course, since I was announcing my positions yesterday, you guys know where I stand on today's action. It was a nice downside move for a lot of the major market indexes. Certainly some macro and global events which are fueling that, we'll just say maybe a little bit of fear out there in the global marketplace, which we'll talk about on today's show. Now, if you guys would like to participate on today's show, you know what to do. You go to powertradingradio.com, click the little button there that says Power Blast, and you can send on in your comments and questions, as I've got a couple here ready to go for today. Of course, you can join our live commentary. We've got Friday out there with Brendan and Ruben on the Power Trading Radio YouTube channel. If you go over to the Online Trading Academy YouTube channel, you've got Gayer all by himself out there right now. But I'm sure more will be joining him soon, so say hello to Gayer and have a great session and send in questions in the chat. We'll get to them. All right, since it's a weekend edition, you guys know what happens on Fridays. We get the Ambassador of Opportunity, John O'Donnell, to join us. As you can see from the lack of seats in the studio, he's not here with me on set, but he is on the phone today. John, how you doing?
Doing good, Merlin. How are you?
I'm good. It's Friday. I can never complain about Fridays just because it's Friday and I don't have to do anything tomorrow or Sunday. So, yeah, it's good. Yourself?
Very good. I'm doing great.
Are you doing workshops this weekend? I keep asking you, but it seems like you're not doing any workshops. What's going on?
Well, it's interesting you bring that up. I just booked, after this weekend, I booked 4 consecutive Saturdays for workshops during the month of February. So starting that very first week of February. So, no, I've been off a bit from that particular schedule, but now I'm back on it.
Sounds good. Well, we'll let our viewers know a little bit later on about John's upcoming engagements. Let's start off talking about macro market pieces. Of course, for those of you who are watching today, I'm not going to usually do the full market review, but I'll show you some charts here. TJ, if you wouldn't mind, bring up some of the more notable ones today. Russell 2000, you guys mentioned yesterday, I had some short positions, which I bought last Friday. Talk about a heck of a rate of return over just a 1 week period of time. Russell 2000 on the day down 1.32%, looking pretty ugly. You also had the 10-year Treasury yields, which may be a topic for John and myself today. Obviously, the price of this ripped right up through that downward trend line, which you can probably get rid of at this point, or as most technicians will do, torture the chart and make it say what you want it to, which is move it to there. We saw it spike up in the 10-year U.S. Treasury note futures, which means yield fell 3.39% to 1.68. We're sub 1.7, which I'm sure is good for many of the viewers out at home. Other noteworthy things, you had gold, which is moving a little bit to the upside. Of course, when you have a downside move like today, that's only natural. So hopefully some of that was good for you. John, a lot of the fear out there is stemming from, a virus, not a computer one, a little human virus going on. What's your thoughts on what's going on over in China?
Well, I've been trying to keep my finger on the pulse of this because these things can be quite nasty. I don't know if a lot of people remember there was something known as the Spanish virus back some time ago. I think it was during the 1920s, and it killed over 20 million people. And so these things can get quite nasty. However, we've got better medical procedures today, hopefully, to contain these things. But according to Bloomberg, they've now isolated over 40 million people, spread over about 32 different provinces. Mm-hmm. And they've got cases that have emerged, according to the Bloomberg report, in 32 of the 34 provinces. So although the WHO has not declared this a global emergency yet, the death toll has jumped to 25 people. This is their Lunar New Year, which is one of the biggest consuming spending periods.
Right.
And they have locked down all forms of public transportation. They've locked down shopping malls. I mean, they have really doing their best to contain this situation because, obviously these viruses clone themselves in such a way that there are no specific treatments
yet.
Other than isolation.
Yeah, we've seen these Hollywood movies before where it just turns into a pandemic. Since we're in the midst of this trade war, obviously, my mind would shift towards the trade side of this. Is there anything that you've seen that really is showing that there might be an impact with regards to trade. Because, of course, if we're getting containers of stuff from China, it might be on there. Who knows?
Well, the Bloomberg report seems to indicate that they're forecasting that GDP in China will be down 1.5% alone because of the virus. That's a report I read this morning. But travel, the totalitarian government of China has the way of just putting out an edict and shutting everything down.
Right.
And if you don't follow the edict, you end up in the gulag. But that being said, they've now restricted all travel packages and that will there's a tremendous amount of tourism from China to the United States.
I love that money.
And if you pull up some of the travel stocks, like the airlines, we're already seeing them getting hit. You're seeing Holiday Inn stock got hit. Marriott stock has already gotten hit. You might want to pull some of those up. And so we're starting to see a bit of fear creep into the travel space.
All right. Well, we've had this happen before. You've had it. Here's the Marriott chart. I didn't have all the ticker symbols, but you can see a pretty aggressive sell-off over the past week in Marriott, and I'm sure that's going to happen for some other ones out there. We've had these in the past, John. I remember the one that comes to mind. I can't remember honestly when it was, but SARS was a big one.
Right.
We had the swine flu and all these different ones. Part of me thinks, okay, this could be something massive, and obviously that would have a massive economic impact and, of course, a horrible loss of life. Although I remember the one that, I forgot, which was the one that was here in the U.S.? Was it Ebola? There was one where people were freaking out about it, and there was like
there was
one death in the United States. One death.
There was one that came out of the Middle East called the MERS. There was the SARS virus. It claimed over 800 lives. There was a Legionnaire disease some time ago that came out of, believe it or not, a convention in Philadelphia. But we've had several of these, and so far we've been able to keep them contained. But and obviously Ebola is a very well-known one. I guess they still have remnants of that going on that sparks up every once in a while in Africa. But but no, we need to be cautious. I mean, I would certainly, I'd just be cautious. And what's interesting is they don't know how long the incubation period is. At first, they thought the symptoms would show themselves in about 5 days. Now they're finding people that have the virus that they have no symptoms, or the symptoms are delayed like 14 days. So you have the ability for this thing, and they believe it has come from an animal and hopped to a human. So this is truly something that could, I think we need to keep our finger on the pulse.
Sure.
Well, so far, the World Health Organization has put out no international emergency. So But let's keep our finger on the pulse.
Well, let's hope it ends up being nothing. And that said, an event like this obviously caused a lot of sway in the market. I think that part of what we saw out there was due to that. Of course, we have the ongoing, I say soap opera, but that almost gives it too much credit. We'll say three-ring circus show, which is this impeachment hearing that's going on right now. That also creating a bit of uncertainty. I personally am not following it in any way, shape, or form. I just don't want to be a part of it all. I think it's just, like I say, a three-ring circus. It's just frustrating and annoying. However, I am hearing people starting to think, you know what, we might start seeing some Republicans switch and actually vote for impeachment. And this was the big thing, John, when you said it's going to the Senate. Senate, clearly Republican favorite. This should not have passed. The impeachment should not have passed. Should not pass through. However, if we do start to see some Republicans switch sides, all of a sudden that changes the perspective. And I'll tell you, if it in fact does pass and they impeach President Trump, I, for one, would expect to see a significant downside move in the equity markets. And right now it doesn't seem like a lot of people are really positioning themselves for that. And I'll tell you why I'm bringing this up and presenting it this way. Because the last two times that I was faced with a situation where people said, there's no way that this is going to happen. Number one of those was Brexit. There's no way that they're going to vote to leave the European Union. I actually made heavy bets that they were going to leave the European Union, and all of a sudden I was rewarded big. And I just basically went with the long shot, total odds-on underdog. And I, of course, with President Trump, I was buying, I bought puts, a significant amount of puts on the U.S. equity markets based off of Trump winning, because there was this expectation that if Trump won, the markets would have a huge collapse. And of course, they did in that after-hour session and have never looked back since. They've just gone up. But remember, it was like 84, 85% chance that Hillary Clinton was going to be president. So you had the slim chance that Trump was going to get there. Everyone's voting against him, and he made it. I'm actually starting to lean to the side that we might actually see this turn and some Republicans voting with their constituents, which seem to be pressuring them to vote for impeachment. And if that does happen, I'd like to get your take. What do you think would happen if there was an impeachment through the Senate?
Oh, I think there'd be a significant downturn in the stock market, in the equity market. I think there'd be a tremendous lift in the bond market, and that would be incredible if we go that direction. Given the fact, now, is it possible? Yeah, could at the last minute some kind of a smoking gun come forward?
Yeah,
which is really compelling evidence and it surprises everybody. And I don't know if you remember when I was younger, they used to have a TV show called Perry Mason. Did you ever see the Perry Mason TV show?
I've heard of it. I didn't watch TV until I was an adult.
He was a criminal lawyer that it seemed like on every show there was somebody. He was always defending somebody for murder, and right at the end of the show, you could always depend upon somebody in the gallery to jump up and say, I did it, don't send my husband to jail. And it was just like there was always this smoking gun and bit of evidence would come out of the woodwork at the very last minute that surprised everybody, and that was the hook for the show that everybody waited for each evening. So could we have one of those? I don't know. I guess it's possible, but I think it'd be a big hit to the stock market if something like that would happen.
Yeah, absolutely. I mean, you got Pence stepping in there, which would be a big wild card for the markets, and who knows, going in election year. It's wild to think about. Part of me wants it to happen just so we can get some really crazy volatility going on out there. Today, I know some of you, I think Bren was talking about being long VIX. Today we had the VIX up 12% today, a little bit of a spike, nothing major. We did have some indexes that were down over 1%, so when the comments come through that says markets aren't down 1%, define markets. It depends which market you're looking at. Certainly there are some that have been down 1% multiple times over the past week. So, something to keep an eye on. I think we've got a lot of really negative things on the horizon. I'm trying to try to be balanced as I usually am, which with negative news. Of course, you have the coronavirus, which a lot of you guys in the chat are thinking is fake. I don't think it's fake. I just think it's blown out of proportion. Also have the impeachment hearings. On the bright side of things, there was some economic data that's been coming out recently. Manufacturing numbers have been looking better and better. So what we'll do is we'll take a quick break. When we come back, we'll talk some about manufacturing. This is an emphasis point that I've been putting on Power Trading Radio for probably about the past year, and saying, look, if we're going to continue to see this market go to all-time highs and keep on ripping, one of those factors is going to be needed to be there to support that will be manufacturing. And it's not just the U.S., it's the global community. We'll see how that stacks up here in just a second. If you guys have questions for John or myself, send them on in at powertradingradio.com. You can click the little button there that says Power Blast, or go to our YouTube channels. We're broadcasting right now on Online Trading Academy as well as Power Trading Radio's YouTube channel. So join the discussion, say hello, send in some questions. We'll be right back after a short break.
What if you knew the income strategies professional investors used? The strategies designed to generate active income from the financial markets. After all, no one's going to care more about your money than you.
I learned that I can be in control of my 401k.
I used to work for money, now I have my money working for me.
With the right training and guidance, you can learn the skills to become a more confident investor and make your money work harder for you. Want to find out what's possible for you? You can, as long as you're willing to take the first step and call OTA today.
Call for your free tickets right now, and you'll also receive a free Professional Insiders kit loaded with lessons from some of our top instructors on topics like enhancing your retirement strategy, capital preservation, and income generation. The Professionals Insider Kit makes it so you can get started right now.
Call 888-304-8723 or visit us online at tradingacademy.com and schedule your free class today.
Click is something I wish I had when I started because it facilitates the learning process a lot quicker.
This is not about taking many trades, it's about taking the right trade.
It helps me save myself from myself. It's just a revolutionary educational tool. It just propels you through the learning curve.
The biggest shock for me is the level of innovation that happens within the company, and it's continuing.
It's just perfect in this new century of trading.
Everyone's on the same side. And I think that's what I love about it more than anything else. Helping each other, supporting each other, all with the same objective. Again, wonderful.
There's no mountain high enough that the leaders in this organization won't climb for their students. They'll just never give up.
It can only help. It can only make one a better trader.
Gives you one of the most valuable things we all have, and that's time.
Welcome back to Power Trading Radio Live with your host, Merlin Rothfeld, and today's special guest.
Hello, everybody. Welcome back to Power Trading Radio. It is your weekend edition. Ambassador of Opportunity John O'Donnell is joining us on the phone today. Before the break, we were talking, I was mentioning about manufacturing numbers. And, of course, manufacturing is something that's key to growth of an economy. It represents jobs. It also represents growth. Now, if we have a market that's been so stellar as this one has been, is there any cracks in the armor, so to speak? Well, we've been looking at the manufacturing numbers for the U.S. for quite some time. The last ones that came out, what do we have for the last ISM manufacturing? We want non-manufacturing. ISM manufacturing PMI was 47 for the U.S. So what this really means is anything below 50 represents contraction, anything above 50 represents expansion. So obviously we want to be 50.01 or higher. Now, for the U.S., we've dropped below there on the ISM manufacturing. For final manufacturing PMI, we're actually at 52.4, kind of holding steady. Today, there were some numbers that came out for the European Union. And when you look at numbers like what France came out with a flash manufacturing number of 51. That was a slight increase, which is showing positive. The other one that was noteworthy was the European Union. Now, their manufacturing number was at 46.9, meaning that there's contraction. I don't think anybody sees that as a shocker for the European Union. It actually came out slightly better, but still below 50 at 47.8. The bellwether, the fulcrum of the European Union, which is going to be Germany, they were at 44.5. They came out today at 45.2. So while they're slightly better, it's still showing contraction out there. Now, I haven't seen any real big spikes up in manufacturing. It's not, not saying that this is doom and gloom at all, but it's just seeing consistently stay at no real increase in manufacturing when we have such a robust market, companies really blowing out earnings and all these things, has me a little bit worried, John. I know you have a different take on manufacturing than I do. What's your perspective on what's going on with the manufacturing numbers?
Well, I am less concerned about manufacturing numbers because we're a service-based economy. I think it used to be that manufacturing jobs represented more than 25% of GDP. It's now down to, I think, somewhere in the vicinity around 10% of GDP. So we're a service-based economy. So if we're losing manufacturing jobs, I would be more interested in seeing our economy grow in a service-based environment, or that seems to be the trend that is causing what economic growth we do have. But I think we're gonna have less than 2% GDP growth this year. I don't think we're gonna get anywhere near. I don't even think we're gonna get a 2% inflation rate. I don't think the Fed's gonna meet their target either. So I don't have the angst about manufacturing jobs like some others do.
I do. You can throw it at me. I have a little bit of. It's not that I'm not saying that this is that piece that just, oh my gosh, if we don't get manufacturing up, it's just one component, and it represents. There's a lot of jobs out there that are tied to manufacturing. So I mean, and if we are in fact in a trade war, and as we're hearing our pundits say that jobs are coming back to the U.S., you would think we'd be seeing more manufacturing production or increase in manufacturing numbers, but we're not seeing it.
Well, I don't think the jobs are coming back.
I don't think so either. But we're hearing that this trade war is bringing jobs back to America.
Yeah, but that was all the political fodder
right.
From the administration for just hopeful, wishful thinking. We were going to bring back all these jobs to make washing machines, and we were going to bring. I mean, I don't see it. We're not going to bring back jobs to make more steel. There's too much capacity to make steel right now, and not enough demand. And look at the price of U.S. Steel shares.
Yeah, right.
They've been demolished. So I think that's just political wishfulness. Is all that is, and I don't think we're gonna. I don't see I mean, look at Tesla. Tesla's gonna, make their automobiles in China. I mean, the vast majority of them, that's another horse of another color. But I don't see all these manufacturing jobs coming back.
No, I didn't. That's why I brought it up. It was just kind of interesting that that's the rhetoric we hear.
And by the way, the reason I believe that is not just because of the price of labor. There's been a tremendous amount of labor that, with the machine tools that we have and robotics and machine learning and all the other new technology we have to increase output. It isn't just because of labor. The challenge in labor seems to be in the retail sector, where you're, usually historically manufacturing jobs paid much more than minimum wage. They pay closer to $25 an hour for a good quality manufacturing job. Well, today you can take somebody and give them an automated robotic machine tool, and you could dramatically, increase output by 25-fold. How much more labor do you really need?
Right.
So I just don't have a lot of angst about, and I have, it'd be great if they did come back. I mean, I want to see more jobs created in America, whether it's in the manufacturing sector or the service sector.
Sure.
But we're a service-based economy, and I think that trend is very well established, and it certainly will be for the rest of my life.
John, let's go back to a chart. Since TJ brought it up here, I may as well look at it and talk about it. You mentioned steel, and U.S. Steel in particular. Ticker symbol is X, which we have on our screen here. We've gotten a few questions from viewers over the past couple of years on this. Obviously, many questions on U.S. Steel, just because a lot of people going, it's a buying opportunity, it's a buying opportunity, it's a buying opportunity. Well, look, back in 2016, U.S. Steel was down in the $6 range. Right now, you're trading, what's it close at today, TJ? $9.40. Now, that's a stark contrast to the high that we achieved back in February of 2018, when we hit a high on U.S. Steel of $47 per share. That's a heck of a drop there. And a lot of people were sending a question saying, is this a buying opportunity in U.S. Steel? Is this a buying opportunity? Which is typical. When things really start to drop like this, a lot of people are looking for the buying opportunity. Let me ask you this, John. At what point do you see a buy here in U.S. Steel? Because at some point, it's going to be attractive. I'll go out even further on this chart so the viewers can see where it's come from over the past couple decades. This goes all the way back into the 90s. In the lowest this one has ever seen was that, was it $6 back in 2016. That's the lowest U.S. Steel has ever been, and we're racing towards that one right now. So at what point do you say, hey, you know what, I'm actually okay buying some U.S. Steel for the long haul?
At or near that $6 print, I might be attracted to it. But that assumes I want to be long steel. If I really wanted to have exposure to steel, I would look at Nucor. Nucor is if I wanted to have that exposure, my first choice would not be U.S. Steel.
Okay.
It would be Nucor. I don't know if can you pull Nucor up?
Sure. Yep. TG got it.
All right. I would. It's not like the money's burning a hole in my pocket to have long exposure to steel.
No.
And the reason is, almost at any price, is because there's so much capacity in the world today with state-of-the-art production tools and furnaces to produce steel all over the world. And there's just now the nice thing about Nucor is they're a bit of a green play in that they use recycled steel, and their inputs are very, very inexpensive, and they've built waste streams that they turn around and take these waste streams of steel and repurpose it into brand new products. So I like Nucor. If I want to get long energy,
okay,
I should be steel. I would lean in that favor.
Yeah, well, I get you. When we do this thing every election, which we'll probably do again at the end of this year, which is saying, look, if this particular candidate wins, here's a portfolio that you might want to build around that specific one, and if this candidate wins, here's a portfolio that's built off of what they have been saying. What was interesting about both Clinton and Trump back in 2016 was they were talking very aggressively about building infrastructure and building up America again. Of course, obviously that brings in jobs, and you would have been led to believe that would have been great for companies like U.S. Steel and Nucor, I guess, but steel companies, period, probably should have done rather well, given the fact that infrastructure is going to require lots of steel. TJ's got the chart up here. You can see Nucor actually did rather well from those election points, right around that low in, was that January 2016? No, we need to go to December. There we go. So you go from the election point in November, December 2016, U.S. or Nucor was at a low of about 47, peaked out. It looks to be right around 70. So a nice run. U.S. Steel really experienced a much greater move to the upside there, and I'll have TJ bring that one up for you guys here in just a second. We're on a monthly. Let's go to a weekly. I think that might be a better representation or better view of that rally up. There you go. So there's 2016. You can go to the elections here, which is right in December. You were trading right around 23, 24, hit a high of 40. So, had about 100% gain, but now all of a sudden, fall from grace, nothing going on for U.S. Steel. So something to keep an eye on. I am with you, John. I'm not that interested in U.S. Steel right now, but there comes a point when you look at a major corporation like this that's probably not going to go insolvent, but consolidate or get bought by somebody else. That $6 mark might be very, very attractive, and I'll maybe buying some there as well. All right.
Yeah, possibly. But Merlin, politicians love to talk about infrastructure.
Sure.
I remember going back to the Ronald Reagan days. That was a very big meme and simply because it's a hot political topic, because the states and regions of our country that produce steel have a lot of blue collar votes, and those are the ones that have been hollowed out. And so all of these those states can be swing states to swing an election.
Sure.
And I think that's one of the reason. You have to, but the price of steel, not just the securities of the companies that produce steel, but the price of steel has dropped precipitously. Okay, I don't know if there's a futures contract on steel or not, but forget the equities for a moment.
Sure.
Matter of it's just the price of a washing machine. This is a big deal about washing machines. You remember that when we had that big, Trump was going to bring. Suspend that company that was going to ship their washing machine production to Mexico.
Yep. What was it? It wasn't Whirlpool. Is Harrier or something like that? I think it's Harrier.
And that all fell apart, by the way.
Of course.
That's just buying votes is all that is. Politicians love to buy votes.
Yeah.
Elizabeth Warren told us the other day that it's day one when she's elected, she's going to forgive 40 million college loans. How many votes would that'd buy a lot of votes if you had power to do something like that.
Just want you to know, John, I'm enrolling to get my PhD before the election, just in case that happens. I'm going to rack up as much debt as I can. All right, let's talk about debt. We're on that vein right now. You sent me a chart earlier. This is actually from CNBC, which I can't even believe we're using the chart. Federal Reserve balance sheet versus the S&P 500. We've had the S&P 500 just on an absolute tear, showing a little hesitation, but really nothing big if you look at the grand scheme of things with regards to the move. On this chart, that's noted by the, I don't know what color, I'm going to say purple or dark blue line. On the other axis, which is on the right-hand side, you have the Fed balance sheet. Now, that number should be in thousands, right? Because that's not going to be that's okay, so that's trillion. I was looking at it going, that number doesn't seem right. Their balance sheet's way bigger than 4.2 million, so it just doesn't say in thousands.
About 4.2 trillion.
Right. Interesting that you're seeing the tail curve off here. Now, okay, this is a little bit different because we also have the can't even think of the repo market purchase buyback, which is skewing this a little bit. But if you see this curve rolling over like it is right now, clearly I think we would all agree, I don't think I'll get any objection from the audience out there, that you have the Fed has been fueling this rally. And if the Fed stops doing what they're doing, which I don't think that they can, I think they backed themselves in a corner here, that could help stall this rally. So what do you make of that nice downturn that we see in this most recent chart here of the Fed balance sheet?
I think it's simply a pause. If you look back in time, you've had a couple of other periods of time where there was a pause. I think this is only a pause. They don't want to call it QE, but it has the same impact as QE. And if you talk to Bill Addis about it, and I know you've had him on the show on a couple of occasions, it's to the tune of approximately, on average, of $100 billion a month. I mean, that's very QE-like.
Yeah.
So it's the same old game, Merlin. Don't look at what they say. Look at what they do. And it's pretty obvious to me the Fed's all in. I mean, they're all over.
But they don't have a choice. I think at this point, if the Fed didn't do what they were doing, they'd be voted out, or we'd have, we run out there with torches and pitchforks after these guys because you got to bail the markets out.
Well, they're also, Trump is bullying. I mean, our Twitter in chief is constantly bullying them into. He's advocating an environment like negative interest rates, like they have in Europe. I mean, I don't know where he comes up with this stuff.
Hey.
I guess if you have a background as a real estate developer, you would be in love with negative real estate, with negative equity.
Well, if anything you can do to fuel the market under your administration, that would be a good thing. And of course, negative interest rates might be one thing to help fuel that market. You punish people for saving.
So is the repo market going to continue? Yeah, probably. I mean, who else is capable of filling the void?
China.
You know. Well,
how crazy would that be? We have a foreign power backing our repo market.
Well, they certainly buy a lot of our treasury paper.
They do.
And not only that, but they certainly like condos in Seattle. There's a lot of flight capital still coming out of China.
Yeah.
I don't know if it's going to come and slow down a little bit because of this crisis with the virus, but there's still a lot of money coming out of that country.
Absolutely. I'm going to back things down a little bit here. We're getting near the tail end, and I had a question come in from Jeff. He was asking about FDIC insurance. Now, I'll real quickly give you the quick answer to this, and I want to get your take on it, John. Jeff says, can you review how FDIC insurance works with regards to the amount insured and having multiple accounts with different to the same institution? So your per account, per institution, per, I believe it's account type, all right, depends how the account's titled, is $250,000. So if I were to have 2 deposited accounts at the same bank in the same type of account, like 2 savings accounts at a Wells Fargo, and each one of those had $250,000, only one of them would be insured. If it was a different type of account or under a different name, potentially I could have multiple at the same branch. That's why I move my money and keep it at a variety of different financial institutions, simply because I don't trust banks, period. I believe they're a necessary evil to store money at or to get the income streams through things like CDs. But that's basically the gist of how it works. If you have multiple, you have a lot of money, I would definitely spread it around, never keep it all with one institution, and go with the major ones because, as we know, they're too big to fail. They'll get bailed out. My other part of this is FDIC insurance as a whole, John. I know, if I remember correctly in the past, you had some pretty negative thoughts on FDIC and their ability to even to bail out the network or the system should it collapse.
Well, I think the total amount of assets available is less than 1% of the total deposits.
Ouch.
Less than 1%. So if there were a crisis, there's just going to be, if the bank becomes insolvent, the FDIC is going to step in to the best of their ability. They don't have unlimited, they don't have a printing press, by the way. They would have to go to Congress to get more funds. And that window's open to them, but they don't really have a printing press. There has to be the political will to bail them out.
Yeah.
Now, 1%, I don't know about you, Merlin, but let's assume you have some life insurance. Would you feel comfortable if the insurance company that underwrote your life only had 1% of the capital available?
Well, it's the same thing like earthquake insurance. You know, the California Earthquake Authority. You know, they keep telling you need to have insurance. If the big one hits, they'll just go insolvent and belly up, and there's no way they'd be able to fund it all.
That's right. And if there was, and what they will do, they will, as they always have, they will negotiate a shotgun marriage, as they did with, when we saw Bear Stearns and Lehman Brothers,
right,
and Wachovia and Washington Mutual when they became insolvent. They basically ended up in a shotgun marriage. They do a crash down evaluation on the company, and the FDIC takes on the responsibility to pay some of the liabilities, and then the purchasing bank in the shotgun marriage, who probably has a healthy balance sheet, has to take on the balance.
Yeah.
So, if we have a real economic depression, like we had in 1929-32, of course, in that era, we had no FDIC insurance.
Right. Well, we
but
won't.
The real question would be, you can't bail them all out.
Our Fed won't let that happen. All right? I see. All right, look at the clock. It's ticking. It's getting late here, John. What you mentioned you got 4 back-to-back Saturdays where you're doing some engagements. Where are you going to be?
Well, starting in the first week of February, I have 4 consecutive Saturday events, power trading workshops. One is in Long Beach.
Oh.
One is in Woodland Hills, and two are in Westwood.
All right, keeping it local.
And as we get closer to those, on the Friday before each, when I come onto the show, I'll announce the location and time.
Cool. Sounds good. All right, John, well, I hope you have a fantastic weekend out there. There's not really much going on. We've got the Pro Bowl. Of course, we got 2 weeks away from the Super Bowl, which will be pretty darn exciting. So I hope you have a nice, relaxing weekend, and thanks for coming on the program today, my friend. See you next week.
I have one other announcement I'd like to make.
Sure.
You ready for this?
Bring it.
Yesterday, on Hour with the Pros, I recorded a new, updated version of my talk, Globalization 3.0, Opportunities in the Age of Accelerated VUCA. So if we've got any Online Trading Academy listeners out there today, I encourage you to go to the archive of Hour with the Pros, and they'll know how to get to it, or they can contact their education center that will show them how to get to that content. And there's a brand new, hip, slick, and cool, updated webinar where I up some brand new content I think they'll enjoy.
Nice. Well, good. Can we update the title, though? Can we call it Globalization 4.0?
Well, let's negotiate, and I'll make it 3.5.
Done. Book it, Dano. All right, John, thanks so much. Have a fantastic weekend.
Thanks.
Guys, that was John O'Donnell. We call him the ambassador of opportunities, always thinking about macro pictures and big picture items. No, we didn't talk too much about Austrian economics, which John likes to go down that rabbit hole sometimes, but we kept it on some of the more timely topics. Of course, today was really more macro picture pieces. There's a lot of stuff out there facing our markets right now, which could create some potential havoc. I'm positioned short right now, which is good. Well, at least from the equity perspective, commodities I'm long, and cryptos I'm long on as well, just because I feel like we're due for a pullback, which is fine, and technically it kind of set up some of the things I was looking for on these charts as well. So to go to Jeff's question, he says, yesterday I think you said you were short Russell, ES, and NQ. Yes, I am short all three of those with options, though. Those are put outright. And the reason for that, he said, why are you in three? Doesn't it increase your risk? No, it reduces my risk because I'm spreading around through three different indexes. And what's interesting about that is you have one that's holding rather strong, and you have one that's incredibly weak. Fortunately, my larger position there is a Russell 2000, which has been very, very weak over the past week. It's hard to beat that rate of return. I know I see some chatter out there about people not using options, not liking options. You're not going to beat the rate of return that options have given you on the last week on this market sell-off. It was pretty phenomenal out there for the Russell 2000, even though it wasn't a big percentage decline for the index when you're leveraged with something like options, pulling a pretty hefty percentage. We'll see if it continues on. I did not close that position, but I think when I close it out, I'll actually look at right now. No, when you look at it, waste our time. So yeah, those are the three positions in the equity indexes. And then you also talked about why would I be going long gold? Again, that's the uncertainty play. I feel like there's too much uncertainty going on with the virus, with the impeachment trials and other things out there. I just feel like you're going to see a nice little pop up here. I don't think it's the boost gold to 1,700 by any means, but I am long physical gold out there. I don't usually play the derivatives, but I'm a physical gold long. All right, let's go to TJ. Bring me up your what do we got, the next week's calendar already? It should be up there somewhere. For those that would like to know more about some of the stuff we talked about today and how it might impact you in your trading, you can find out more information about Online Trading Academy by calling any of those numbers on our commercial breaks or clicking one of those links that's showing up in your social media channel right now. Joanne's probably ready to let those links out, let you guys know how to get in touch with us. There are 48 physical brick and mortar schools around the world. As you guys heard, John O'Donnell doing some presentations in Long Beach, Woodland Hills, and Westwood. A lot of those are free. There's free classes, paid classes, community events, and just a whole bunch of resources to hopefully help you understand how these markets can be better utilized in your personal finances. So if you want to know more, click on those links. Or if you're listening to the iTunes podcast, thank you guys so much. I'm surprised we have such a huge iTunes following. We love it. Go to powertradingradio.com. There's a button at the top that says free class. Click it. Find out more information as well. All right, TJ, Monday, January 27th, bringing in the final week of January. I can't wait to see how goes January so we can anticipate how it goes the rest of the year. If you look at that one, you've got new home sales for the U.S. markets. You also have for Germany, IFO business climate numbers. British pound has high street lending. Australia with NAB business confidence, and then Japan with the BOJ core CPI numbers. Moving on to your earnings, it's nowhere near what it was the past week or two. It's been phenomenal the past 2 weeks. Really, really love the way that these markets were volatile because of especially the banking earnings. Look at the names on Monday. It's not that great. We've got DR Horton, Equity Lifestyle, Arconic, yeah, Brown & Brown. And then the name I'm just going to skip because TJ threw that one on there, and I, for some reason, cannot pronounce that one. That's an absolute tongue twister. I'll do it in syllables. PerkinElmer. There you go, that was easy. And then Whirlpool reporting earnings as well, speaking of washing machines. A guest for the show on Monday will be Robert Dumar. He's a new guest on Power Trading Radio, I believe. We're going to talk about trading it all. He actually trades all the different asset classes, been involved in financial markets for quite some time. So it'll be a get to know Robert, his evolution experience as a trader, how he became the instructor and trader that he is today, trials, tribulations, all the things he had to do to overcome to be successful in these financial markets. So we'll start with that on our Monday show. If you guys have questions for me, send them on in at powertradingradio.com. You can do that 24 hours a day, 7 days a week by clicking that Power Blast button. If you'd like to learn more, again, you can click those links showing up in social media or at powertradingradio.com as well. Until then, happy trading, everybody. We'll see you next week. Take care.
You're listening to Power Trading Radio live. Watch the show live or on the archive at powertradingradio.com and YouTube. Or download the podcast from iTunes or wherever fine podcasts are downloaded.